Welcome everyone. Today we are going to take a close look at the exponential moving average. By the time we are done, you will understand what the exponential moving average is, how it works, and how it can help you make better decisions. This might just be the key to helping you take your trading to the next level, so stick around. We are going to cover a lot of ground together. Imagine having the ability to spot a new trend before most traders even see it coming. The exponential moving average can help you do just that. By focusing more on recent price changes, it reacts faster to shifts in the market. Unlike other types of moving averages, such as the simple moving average, it is quicker to respond to price movement. This gives you a chance to catch trends right from the beginning. Acting on these emerging trends with confidence gives you a real advantage in making smart trading decisions. Another key benefit of the exponential moving average is its ability to help spot chart patterns that signal potential price movements. Let us talk about a few common patterns: double tops, double bottoms, head and shoulders, and flags. These patterns can be more accurately confirmed when you use exponential moving averages with other tools. Recognizing these patterns helps you understand when a price trend might continue or reverse. This is crucial for deciding when to enter or exit a trade. An *** double top ** pattern is when the price hits a high point twice and then starts to fall. It is usually a signal that the uptrend is losing momentum and could reverse. When the price then falls below the exponential moving average, it is a stronger confirmation that a downtrend might be starting. A ** double bottom ** pattern is the opposite. It forms when the price hits a low point twice, indicating that selling pressure is weakening. If the price moves above the exponential moving average after forming this pattern, it could signal an upcoming uptrend. The ** head and shoulders * pattern is another major signal. It has three peaks, with the middle peak being the highest. When the price moves below the exponential moving average after forming this pattern, it is a strong sign that the market could be heading down. The inverse head and shoulders pattern works similarly but in the opposite direction, signaling a potential upward move. ** flag patterns * are also useful. These patterns form after a strong price movement, followed by a period of consolidation that looks like a flag. If the price breaks out of the flag pattern and crosses the exponential moving average, it can signal that the previous trend is continuing. A bullish flag shows that an uptrend may continue, while a bearish flag indicates that a downtrend could persist. **, wedges * are patterns that signal a loss of momentum. A rising wedge forms when the price makes higher highs and higher lows but starts to lose steam. If the price then breaks below the exponential moving average, it is often a sign that a downtrend is coming. A falling wedge is the opposite. It forms when the price makes lower lows and lower highs but starts to lose downward momentum. When the price crosses above the exponential moving average, it can be a strong signal of an upcoming uptrend. By combining these chart patterns with the exponential moving average, you can gain a clearer picture of where the price might be headed. Using these signals helps you make better decisions about when to buy, sell, or hold a position. Now let us take a moment to understand how the exponential moving average is actually calculated. Unlike the simple moving average, which treats every price point equally, the exponential moving average uses a special method to give recent prices more influence. The result is a line that adjusts faster to what is happening right now. Imagine a 10-day exponential moving average. The prices from the last couple of days are much more important than the prices from 10 days ago. This is why traders love using this type of moving average to make quicker decisions. The exponential moving average just gives you a much better picture of what is happening right now. You might be wondering how you can use the exponential moving average to spot trends. Well, it is pretty straightforward. When the price stays above the exponential moving average for a long time, it often means that an uptrend is happening. Traders will take this as a sign that things are moving up and that it might be time to think about buying. But if the price stays below the exponential moving average for a while, it can mean that a downtrend is happening. In this case, traders may decide that it is time to sell or to stay away from buying for now. A shift in trend often happens when the price crosses above or below the exponential moving average after sticking to one side. So, pay attention to these moments because they could tell you that things are about to change. In addition to looking at whether the price is above or below the exponential moving average, it is also helpful to recognize specific chart patterns that can give clues about what might happen next. For example, a double top pattern is a bearish signal that forms when the price reaches a high point twice, with a slight decline in between, and then falls below the exponential moving average. This pattern suggests that the buying pressure is weakening and a downtrend could be on the way. A double bottom pattern, on the other hand, is a bullish signal that forms when the price hits a low point twice, with a slight rise in between, and then moves above the exponential moving average. This pattern suggests that selling pressure is decreasing, and the market might be ready to move upward. Another important pattern is the head and shoulders pattern. This pattern has 3 peaks, with the middle peak being the highest. When the price moves below the exponential moving average after forming this pattern, it is often a sign that the market is heading into a downtrend. The inverse head and shoulders pattern works in the opposite way and is a bullish signal, indicating that the market could be about to move up. Flags are another common chart pattern that traders look for. A flag pattern forms after a strong price move, followed by a period of consolidation that looks like a flag. If the price breaks out of the flag pattern and crosses the exponential moving average, it can signal a continuation of the previous trend. Bullish flags indicate that an uptrend may continue, while bearish flags suggest that a downtrend could persist. Wedges are also useful patterns to watch for. A rising wedge is a bearish pattern that forms as the price makes higher highs and higher lows, but with decreasing momentum. When the price breaks below the exponential moving average after forming a rising wedge, it can signal the start of a downtrend. Conversely, a falling wedge is a bullish pattern that forms when the price makes lower lows and lower highs, but starts to lose downward momentum. If the price crosses above the exponential moving average after forming a falling wedge, it can be a strong signal of an upcoming uptrend. Recognizing these chart patterns along with using the exponential moving average can give you a clearer picture of potential price movements. These patterns, when confirmed by the exponential moving average, can help you make more informed trading decisions and understand when a trend is likely to continue or reverse. Setting up an exponential moving average on your chart is really easy to do. You get to pick different time periods, and this will depend on how you prefer to trade. If you like short-term trades, you might use a 12-day exponential moving average. If you are more of a long-term trader, you could choose a 50-day or 200-day exponential moving average. These longer averages help you see the bigger trends. You do not have to worry about the calculations because most charting platforms will do it for you. All you need to do is choose the time period you want, and the line will be there on your chart, ready to help you spot trends and reversals. One powerful way traders use the exponential moving average is by looking at crossovers. A bullish crossover happens when a shorter-term exponential moving average, like a 12-day exponential moving average, crosses above a longer-term one, like the 26-day exponential moving average. This tells us that the market might be starting to move up, and it could be a good time to buy. On the other hand, a bearish crossover is when the shorter-term exponential moving average crosses below the longer-term one. This could mean that the market is starting to go down and that it might be time to sell. Imagine seeing the 12-day exponential moving average crossing above the 26-day exponential moving average. This is often a signal that things are moving up, and it might be worth considering buying. The exponential moving average is not just good for trends. It can also act as a support or resistance level, making it a valuable tool for identifying key price points. Think of an uptrend where the price pulls back, but then bounces right at the level of the exponential moving average. This behavior suggests that the uptrend is strong, and traders often use this pullback as an opportunity to enter or add to their positions. In an uptrend, the exponential moving average acts as a ** dynamic support * level, which means it adjusts with the price, providing a more flexible reference compared to static horizontal support levels. If the price consistently respects the exponential moving average as support, it indicates that buyers are stepping in and maintaining the trend. In a downtrend, the exponential moving average can act as * dynamic resistance *. If the price moves up to the exponential moving average but fails to break above it, this signals that the selling pressure is still strong and that the downtrend is likely to continue. Traders may use these points as opportunities to enter short positions or avoid buying until there is a clear break above the resistance level. Another helpful pattern is when the price touches the exponential moving average multiple times without breaking through it, either as support or resistance. In an uptrend, a 50-day exponential moving average might act as support, and repeated bounces off this level reinforce the strength of the trend. If the price gets close to the exponential moving average and moves back up, this could be a signal that the trend is still intact, and traders can consider it a favorable moment to enter the market. The exponential moving average can also be combined with other patterns for better confirmation. For instance, if the price forms a * bullish engulfing candle * right at the exponential moving average support, this further reinforces that the level is holding as support, and it provides a strong buying signal. A bullish engulfing pattern typically indicates that the buyers are regaining control, especially when it forms at a support level such as the exponential moving average. Additionally, traders should look for increasing volume during the formation of this pattern, as this strengthens the signal that the market sentiment is shifting towards the bullish side. Similarly, if the price forms a * bearish engulfing candle * at the exponential moving average resistance in a downtrend, it may be a good opportunity to enter a short position. A bearish engulfing pattern shows that sellers are stepping in with strong momentum, and when this forms at an exponential moving average resistance, it suggests a potential continuation of the downtrend. As with bullish engulfing, volume plays a crucial role. High selling volume adds weight to the signal and suggests that the trend reversal or continuation may be more reliable. Another powerful candlestick pattern that can be used with the exponential moving average is the hammer, and hanging man pattern. A hammer is a bullish reversal pattern that forms after a decline, with a long lower wick showing rejection of lower prices. If a hammer forms at or near an exponential moving average acting as support, it suggests that buyers are stepping back in, making it a potential buying opportunity. Conversely, a hanging man is a bearish reversal pattern that appears after an uptrend. If a hanging man forms near an exponential moving average resistance, it could indicate a weakening uptrend and a potential reversal, signaling traders to consider short positions. Traders can also use morning star, and evening star, patterns with exponential moving averages for added confirmation. A morning star pattern is a bullish reversal setup consisting of 3 candles, a large bearish candle, followed by a small indecisive candle, and then a large bullish candle. If this forms near an exponential moving average acting as support, it suggests a strong potential for an upward move. On the other hand, an evening star pattern is a bearish reversal pattern that forms after an uptrend, consisting of a large bullish candle, a small indecisive candle, and then a large bearish candle. When this occurs at exponential moving average resistance, it is a strong indicator that the trend may reverse to the downside. By using these candlestick patterns alongside the exponential moving average, traders can better determine whether support or resistance levels are likely to hold, and they can make more informed decisions on when to enter or exit positions. Recognizing these candlestick signals at key exponential moving average levels can significantly enhance trading accuracy and timing. By observing how the price interacts with the exponential moving average during different trends and using additional candlestick patterns for confirmation, you can gain more insight into whether the trend is likely to continue or reverse. This kind of thorough analysis helps in making well-informed trading decisions and improving overall strategy effectiveness. If you want to make your signals more accurate, try combining the exponential moving average with other indicators. For example, the relative strength index is a good match. If the exponential moving average shows a bullish crossover and the relative strength index indicates that the market is oversold, that is a stronger buy signal. Another great indicator to use with the exponential moving average is the moving average convergence divergence. Since the moving average convergence divergence is based on exponential moving averages, when the moving average convergence divergence line crosses above the signal line during an exponential moving average crossover, it can confirm the trend strength. Also, always check the volume during these crossovers. A strong exponential moving average crossover with high volume suggests that the trend might be reliable, while low volume might mean that the signal is weak. The great thing about the exponential moving average is that it works for different styles of trading and can be adapted to fit your trading goals. Let us dive a bit deeper into how exponential moving averages can be used with different trading styles and chart patterns to help you make well-informed decisions. If you are a day trader and want to capture quick moves, shorter exponential moving averages like 5 or 10-day exponential moving averages can help you make faster decisions. These shorter-term exponential moving averages are very sensitive to recent price changes, allowing you to react to shifts quickly. For example, as a day trader, you can combine shorter exponential moving averages with patterns like bullish and bearish flags to anticipate trend continuations after a period of consolidation. When a flag pattern forms and the price breaks out in the same direction while staying above a 5 or 10-day exponential moving average, it confirms a continuation and can provide a good entry opportunity. If you are a swing trader, the 12-day and 26-day exponential moving averages can help you spot trends that last several days. These timeframes are great for filtering out short-term noise while still keeping up with the overall trend. Swing traders often look for patterns like head and shoulders or wedges that form over a few days to weeks. Combining these patterns with the 12 or 26-day exponential moving average allows you to confirm the strength of the trend or the reversal. For example, if you see an inverse head and shoulders pattern and the price moves above both the 12 and 26-day exponential moving averages, it can be a strong bullish signal, giving you more confidence in entering a long position. If you are a long-term investor, then you will probably want to look at the 50-day or 200-day exponential moving averages. These longer-term exponential moving averages help you avoid all the small ups and downs that do not matter as much when you are looking at the bigger picture. Long-term investors often combine these exponential moving averages with patterns like double tops, double bottoms, and long-term trend channels. For instance, if the price forms a double bottom and then crosses above the 50-day exponential moving average, this could indicate a strong trend reversal and a potential buying opportunity. Additionally, the 200-day exponential moving average is often used as a benchmark for overall market health. If the price is consistently above this level, it suggests a strong bullish market, whereas a break below it could signal potential long-term weakness. No matter your trading style, recognizing and combining chart patterns with exponential moving averages provides a more robust analysis of market conditions. Day traders, swing traders, and long-term investors can all benefit from the flexibility of the exponential moving average, using it to make precise and timely decisions based on the specific chart patterns they observe in combination with these averages. But do not think the exponential moving average is perfect. There are some common mistakes that people make when they use it. One big mistake is thinking that every crossover means a big trend is coming. Not every crossover leads to a major move, so it is important to get confirmation from other indicators like the relative strength index or the moving average convergence/divergence before you jump in. Another mistake is not paying attention to what else is going on in the market. The exponential moving average focuses on price, but big news events or economic data can change everything. You need to keep an eye on the bigger picture, and of course, always use stop losses. Even if you have a great setup, things can go wrong. Stop losses help protect you and limit your losses. If you are just getting started with the exponential moving average, it is a good idea to practice with a demo account. You can experiment and get used to seeing trends and figuring out when to enter and exit without putting real money at risk. Keep track of your trades in a journal. This will help you learn from your mistakes and see what works best. Additionally, pay attention to specific chart patterns and how they interact with the exponential moving average. Practice identifying patterns like double tops, double bottoms, head and shoulders, and flags, and observe how the exponential moving average confirms or reacts to these formations. Try different time frames to see which chart patterns work best for you at various intervals. You might find that short-term exponential moving averages are best for identifying quick flags or wedges, while longer-term ones help you identify major reversals or support levels. It is all about finding what works for you and combining the exponential moving average with the right chart patterns for your trading style. To sum it all up, the exponential moving average is a powerful tool for spotting trends, identifying buy and sell opportunities, and finding support and resistance levels. Its ability to react quickly to changes makes it a favorite for traders who need timely signals. So go ahead, start adding exponential moving averages to your charts and combine them with other tools to make the best possible decisions. Remember to keep an eye on volume and the bigger market picture. With some practice, you will start to feel more comfortable using the exponential moving average and seeing how it can improve your trades. Ask questions, try different settings, and keep learning. The more you practice, the more confident you will be in your abilities.